let's talk a little bit about conventional financing. These are your banks, and you've got local banks that are really driven by the relationship, meaning they know you, they know what you do, how you do it. Regional banks are more driven by what their allocation is for commercial real estate, and within that, what their allocation is for the product type that you're trying to finance. National banks, they're more about just looking at the property and whether or not the debt is going to be attractive on the secondary market, meaning once they write the debt, can they transfer the loan to somebody else and get their money back and move on to another one. So starting at the bottom, your local bank is probably going to want your deposits for that entity. So your operating account, maybe your deposit account, all that stuff is going to be run through the local bank. And it's about your relationship with, the senior leadership there. The senior loan officer, the commercial loan officer, is generally, higher up on the food chain, and may even sit on the committee, the loan committee, that's going to make the decisions on your loan. And so their job is to find successful opportunities, businesses. Every piece of real estate is a business. Their job is to go out in the marketplace, find successful opportunities to be able to fund. And so that's how they earn their money, by taking deposits, putting that money into a loan, earning interest on the loan, earning fees for doing the loan, and basically requiring all your cash flow to run through their entity, so they have more money on the books to show what their capital level is, and they can lend more money. So that's how they kind of sustain themselves. Regional banks are going to be more about the property itself. I mean, obviously the local bank is going to look at the property as well, but they're going to look at you as well. Regional banks are going to focus more on the property, and if it makes sense for their allocations. And then obviously you still have to qualify as far as credit, and not so much income from you, but income from the property. But they also want to look and see what your track record is. How many kinds of these deals have you done? Have you done any of them? What's the management like for the property? Are you going to self-manage or hire a manager? All that kind of stuff comes into play. And then also they might look and see how your net worth, excluding the deal you're financing, compares to the loan amount. You'll get some lenders that they want your net worth to exceed the loan amount that they're about to lend, with the feeling that if it's recourse financing, not only do they have the option of foreclosing on the property and taking back the collateral, they also have the option of looking to you for additional assets to cover any shortfalls on that collateral. So one thing to keep in mind is looking at your purchase price or your appraisal price. These conventional lenders are going to go with the lower number. So if you have a purchase price of $2 million and it appraises at 1.9, they're going to lend on 1.9. If it appraises at 2.1, they're going to lend on 2, which is your purchase price. So the loan to cost or the loan to appraisal, they're going to go with the lower one to finance your deal, to underwrite your deal. They're also going to look at the debt yield. Debt yield is a simple calculation of what the loan amount is divided by, what the NOI is, the current NOI on the property divided by the loan amount. So if you have a NOI of 100,000 and they're going to lend $1 million on that, their debt yield will be 10%. So basically, if they took the property back for the amount of the loan and they took over the management of the property and collected the cash flow, the NOI, they could see what their yield is on their debt, right? And so in addition to debt service coverage ratio, they're going to look at the debt yield and make sure that, typically it's going to be anywhere from 8 to 10 to 12% based on what the loan to value is for the deal. While we're talking about it, debt service coverage ratio basically means that if your annual debt service is 100,000, they want to see an NOI of at least like 125, so that'd be 1.25. That's on the low end, probably the bare minimum. If you're just starting out, don't have a big track record or a big balance sheet or net worth, then you can expect to, for them to see 1.35 or 1.5 even debt service coverage ratio. This is all stuff, as far as underwriting commercial loans. You could do a 10-hour video on this subject, but from the high level point is your local banks are going to look at the relationship and your deposits. Your regionals are going to look at the property and you. They're not going to be concerned as much with your deposits. And then national banks, they just want to make sure that you fit the box, the property fits the box, and the mortgage is standardized enough where they can sell or assign that mortgage to the secondary market and get their money back and go do it again. And so you'll see that the national banks will, stick a bunch of mortgages together, create a pool, of $500 million or $1 billion, and take that pool to Wall Street and securitize it. Commercial mortgage-backed securities, CMBS. You can go direct to the CMBS market. We did that on our apartment refinance back in 2016, where basically we had a sponsor of the pool refinance our apartments, took that new mortgage that was created and put it with a bunch of other mortgages, and then took it to the securities market and securitized that loan. That's one way of doing it. It's a little bit more, at the time it was a little bit more expensive because the rates, the interest rate or the coupon for our debt moved around a little bit before we closed, and any move in the 10-year, which is what it's tied to, the 10-year T-bill, moved up about 50 basis points in between our application and our closing, and we had to basically absorb that to get closed. So anyway, doing a CMBS deal is more sophisticated, a lot more moving parts, a lot more parties looking over the shoulder, so to speak, because they want to put that money out for your loan, and then within 90 days put it with a bunch of other loans, securitize it, and then sell it to investors all over the world. So it's got to fit into their box to get it done. So, and your national banks, that's what they basically do. They'll either securitize it and sell it off, or they'll sell it off in pieces to other banks that are looking to earn the coupon on your loan. It might not be a bank, it might be a life insurance company, a pension fund, anybody that's interested in then earning interest on commercial real estate debt.